So, how is it possible to buy an apartment building with no money down? Well, my guest today, Matt Faircloth, has done this and he's actually scaled his apartment portfolio to over 1,350 units. So, really excited to hear that story. Matt, how are you today?
I'm awesome, Bronson. It's grateful to be here.
Awesome. Really glad to have you. So, how did you do it? How did you buy? And first of all, tell us a story on this apartment. How big was the apartment and how did you do that with no money? And I'm really curious.
It's funny. I mean, there's a little bit of not saying it's whatever you want to say it is, but it's kind of read a certain way can be read to mean a certain thing. But there certainly is money that transacts. It's not like I just walk up and look at the apartment building and say, "Hey, can I have that?" I mean,
I knew that.
that is a financial transaction that happens. There is money that's given to the seller from us, part of which, of course, through a bank loan. But it is that video that we shot on our YouTube channel that it has something like 250,000 views or whatever, is a baseline education video on how to handle a syndication, on and the real story is that I bought that that was an 18 unit building that we bought in Northeast Philadelphia. And we bought it for no money out of our own pocket. Right. And so but the down money, like the earnest money that comes when you typically post to buy a property, that's something that in a lot of circumstances where if you don't have the initial check, you can partner with a capital partner from day one that can front a lot of that. In my book, Raising Private Capital, I talk a lot about deal providers and cash providers. And there is a misunderstanding in the industry that that you've got to provide all things. You got to provide the cash, you got to provide the know-how, the knowledge, the resources, the muscle, the contacts, the business plan, all this stuff to make the deal work. And you've also got to provide the balance sheet, the dollars, the everything of all of those things. That'd be in a perfect world, it would be all of those things that I just said you have to bring to the table to be a successful homeowner or a successful small property purchaser. But when you get into small and mid-sized multi or smaller mid-sized real estate, what's great is you can start divvying up roles and responsibilities of all those things I just said. And so Raising Private Capital talks about in that, like on that deal, where we provided those things. We provided the deal, the know-how, the knowledge, the management team, the business plan, all those things. And then investors on the other side of it provided the passive capital to be the earnest money deposit, to be the equity in the deal. And we provided the bank loan to bridge the rest. So it was a 75% down purchase. So 750,000 came from a bank, 250,000 came from investors, plus the closing cost, plus the money to renovate the property.
Yeah. So I think what you shared, I think is going to be there's going to be a real light bulb moment for a lot of people. When I first got into real estate, I did single family like a lot of people do, and they start with single
Mm-hmm.
family. And I had 4 or 5 houses, and was working with a family member. And then I have a cousin who's a little more of a distant cousin. Said, "Hey, why don't you do multifamily?" And I said, "I'd love to, but I don't have the money." He said, "We can raise the money." And it was just read this book, go to this podcast, or listen to this podcast, go to the
Yeah.
conference. And it's amazing the power of other people's money. And when you really align yourself with people that are really they have a money problem, meaning they have
Mm-hmm.
money and they don't know where to put it to get a good return. And so when you're able
Mm-hmm.
to kind of help solve those problems, sometimes you can do it with little or no money down. And it's a great way to get going. So that's really real estate syndication and how it works. So talk to us a little bit about your journey and kind of how you got started and into multifamily and just kind of what you like about it, kind of a little bit of your journey on that.
Well, we kind of stepped into it one step into another. And I'll answer your last question first. What I love about it is we want to make an impact. The mission for my company, the DeRosa Group, is to transform lives through real estate. We want to make, I mean, I'll get a little, a little fuzzy here. A little teddy bear fuzzy. We want to make the world a better place through what we do. And it's real fun and it's all those things to make money and it's rewarding to make money. But if you're not, I mean, it's easier than you think it is, right? So now that you've gotten money, making money as a box checked on what you want to do, well, what else do you want to do? Well, I want to make a difference. I want to make people's lives better. I want to make an impact. Well, my wife and I, Liz, want to make an impact, a big one. And we want to make the world better through our investments. And so that's the biggest thing I love about multifamily real estate is the biggest way to impact people's lives I've seen, and we've done other real estate investing too, but residential housing provides the best means to make an impact on people. And that's what I love most about residential housing is I can make the tenant's life better, my investors' life better, the staff that works for the property or at the property's lives better, or give them some fulfillment for what they're doing. And that. And so on a lot of different fronts, that's what I love about residential. But going back to our track, right, to our history, our first kind of like you got started in syndicate and didn't get started in syndications, got started in small single family real estate, got started in small stuff and worked our way into it. And our first equity investment that wasn't like immediate friends or family was somebody my wife went to college with that gave us $50K for our first deal. And we took that $50K in equity and went and bought 2 little single family homes, 2 little duplex, 2 little townhomes in Trenton, fixed them up, refinanced them, and did that over and over again, did like a BRRRR strategy with that person's money. They became a great partner of ours and referred more people to us. And that snowball started to get bigger and bigger and bigger, where the word got out that we were doing real estate deals. We kept doing right by people, right by our investors. They told their friends about it. And it just got larger and larger. It went from that project was $50K. Next project was $120K. Project after that was $300K, and then $500, and then off we go from there. Right. And then we just built a track record and built the better, just built it like a better and better what do they call it? Build a better mousetrap each time, built a better business that knows how to run multifamily real estate, and just scaled and grew and took the lessons, took the lumps from our mistakes and grew and expanded and got larger and larger into bigger multifamily. And then the light bulb went. I'll tell this brief story, Bronson. The light bulb went off because a lot of I even wrote an article one time for Bigger Pockets that said, I will never buy a property more than 30 minutes away from my office. Right. It's funny what happens when you put things like out there.
I've done that too. I'll put things out there and I'm like totally doing the things I said I would never do.
I know. But it's like there's a force out there that conspires to make you wrong. Sometimes when you say you'll never do something, it's like, I'll show you what never looks like,
Yeah, exactly.
Right?
Yeah.
So we were managing about 115 units out of our Trenton office. And that included some properties in Philadelphia, including the property you referenced at the beginning of this interview, the no money down, air quote, no money down property, right?
Uh-huh.
That was in Philly, and we managed that one ourselves. And an opportunity came up from that same broker that sold me that property in Philly, said, hey, I want to show you something in Lancaster. And I was like, oh, Lancaster, huh? What do you know? Like a bunch of Amish people are, right? And I'm like, he's like, no, it's a great town. You'll love it. Come out, just take the drive. It's 2 hours away, one way to drive out to this property.
Yeah.
I'm like, how could I send like a leasing agent this far? I can't send a technician this far. I'm totally breaking my Bigger Pockets article now. I can't do this. So I go out there and look at it, and I'm like, this is it. This deal. It was a converted factory. It was a factory, been turned into an apartment building, but it was converted 20 years ago, and all the kitchens and bathrooms and fixtures and everything was all from 20 years ago. That is a perfect value add play. It's like, hey, facelift, man. Let's get in here and take out the old, beige Kenmore, refrigerator and put in a nice stainless steel one. Let's do some facelifts, easy. But I'm like, oh man, I can't do this because I can't manage. And my wife, and I was like, we'll just start up a Lancaster division of the DeRosa Group for our management team. And my wife's like, hey, how about you try something different? How about, because she was like, because she knew that the property management thing was like, I was putting in 80% of my time and making 20% of my money from it. It was the Pareto principle upside down. It was the wrong arrangement of it, right? So she was like, why don't you try not managing that property? What if you handed it off to a third party? I was like, well, that's not really what we do. It's our brand. And she's like, well, you could always take it back, And so we hired a local PM. And that was a game changer because it took my brain out of property management and into asset management and into expansion and into really, really running what an owner should be running, which is 10,000 foot level conversations. Should we sell? Should we refinance? Should we raise rents? What is the management strategy? And then implementing that plan to the manager and letting a property manager just be boots on the ground side. It's because every here and again in Trenton, I was still showing apartments. I was making, collection calls sometimes, when I had to. So, but it took me out of the minutia boots on the ground level thing, and to kind of put me up on a hot air balloon above the business, so I can kind of like look at all of it and see the way things are running. And that enabled me to really design a system and design a next level company that enabled us to lever up into larger stuff. But I'm grateful we went from the bottom up, because I now know tenant interfaces. I know, I've seen it. I've walked more apartments than most apartment building owners have, I've dealt with a lot of the hands-on level of it. But now I don't do that anymore, but I've graduated, if you will, from it. So that's in essence our growth trajectory.
Yeah, so that's a really great point. I'm really glad you bring that up, because I think a lot of people watching this, they're interested in how do I get to that next level, or how do I do an apartment, or how do I and really when it comes to scale and what you talk about with multifamily and syndication in particular, it's like a puzzle, and there's different
Yeah.
pieces that have to be there, right? There you got the operations, you got finding the deal, you've got raising the money, you've got other it's such a team sport. And once I realized I didn't have to do everything, I realized I could continue to grow and scale, because to me, I love working with people and I love being able to raise funds. And I'm not the day-to-day operations person. And can be like being able to adjust and say, hey, I want to do the 10,000 foot view. I want to do the asset management. I want to work on these different elements. And it's
Mm-hmm.
amazing if you can bring value to people, just how much that really adds to them. So let me ask you for a second. For you, when you started, raising money for deals, and you just mentioned you have some big stuff that you're working on now, but
Mm-hmm.
when you started, what's one thing that you wish you'd known before you started raising money for doing apartment deals?
Um, it's a good one. Uh, it's fun. This is funny. This will sound funny. But what to do when an investor surprises you and says yes, because
Yeah,
you end up, I know you've raised a ton of capital yourself, but I mean, like in the beginning, when you're raising capital, you're running around like just trying to get, so just you're kind of smacking your head against the wall trying to get somebody to give you some attention, to be interested in
yeah.
your deal. But at some point, you get your script down, you get the business plan right, you catch the right deal with the right business plan, and you've got your conversation down. You've been told no a bunch of times, and now it's time. Okay, I've learned from all the no's, and now it's time to start hearing yes. And it's almost like a surprise. like,
Yeah.
oh, you do? Really? Okay, awesome. Well, thank you. I'm grateful for that. But then it's like, I didn't have a lot of that backdoor pipeline built about like, okay, this is where you go to DocuSign, this is where you, da, da, da. And over time we had to build out these systems. And that, but I wish that I had built out the second leg of like, okay, now this is where they go, and this is how seamlessly, like, just easy you make it for people. And so that's what I wish that I had known. And we had to build it
Yeah.
on the fly. I mean, sometimes you're like building systems for something that you're in the middle of. Now you're kind of building as you go. Or as friends of mine have said, you're kind of building the parachute, jumping out of the airplane and building the parachute on the way down, kind of thing.
That's it. That's it. That's from
Yeah,
Robert Kiyosaki's book, Before You Quit Your Job. So I
yeah,
read
yeah,
that book before I quit my job, and he talks about jumping out of a parachute, or jumping out of a plane without a parachute and trying to assemble one before they hit the ground. That's his
yeah.
illustration he uses. But no, you're right. I remember having 63 phone calls and conversations with friends and family before my first deal, and they all said no. And I met my first, investor at a meetup that I was leading, and I introduced them to somebody else, and that was kind of my first deal that I got into. But you're right, having processes and things in place, and you kind of figure things out as you go along. With the more insight you can give into that investor experience, it's like when we go to Starbucks or Chipotle, or you fill in the blank, whatever your favorite place is. It's going to be good, or you're going to have a certain experience because of the way that they have their systems and processes in place. And so it's the same with investors. Most of them have never done this before, so you become like a guide that really is holding their hand, walking them through this. So the cleaner and easier and a bit more beneficial that experience can be, the better. So, and I know
Mhm.
you've written a book. I've actually read most of your book, Raising Private
Thank
Capital.
you.
Talk to us a little bit about your book. What made you want to write it, and why should people read it? Like, what's in there that's give us a nugget from your
Well,
book
I
that
wanted to write it because I thought it'd be easy to write a book, but that was really wrong about that. So found that out the hard way. Thanks, Bigger Pockets. And you're like,
Yeah,
you write a
easy.
book. Come
Yeah,
on, you write a lot of articles for us. You're a
yeah.
good writer. You'd be
Yeah,
good. You're
two
good on
weeks. 2 weeks, you'll
camera.
be done. You'll be done in 2 weeks,
Yeah, it'd
right?
be easy. Yeah, it'd be easy. How hard could it be? And that's what I was like. Yeah, they're right. How hard could it be to write a book? No problem. Yeah. And then it was like, oh, this is like a second job that takes a year, this is great. But I am extremely grateful that I wrote it. I'm grateful to have been given the opportunity to write it by them, with them. And I'm very proud of the work as well. The book just really, it is not how to raise lots of money for apartment buildings. That is there. And there is a lot of that in there, but it's really just in general, the way that private capital, the way that private money plays into general real estate investing, that it plays into the flipper that wants to grow and expand, or the wholesaler, or the landlord, the small landlord or the large landlord that wants to grow and expand their business. A lot of that's in there, and a lot of my personal stories in there too. So it's attracting investors, structuring deals with those investors, and then exiting with those investors, mitigating problems with the investor may point out, or issues they may have. All that's in there, and it's chock full of my story of going from one to however many thousand units or whatever it is.
Yeah, some of these stories are really interesting. I was thinking of, you mentioned a problem, problems that come up with investors. I was thinking this best deal we've ever had was a deal in Jacksonville, and there was an investor, not that I brought in, but another partner brought in.
Yeah.
And this guy, my partner, basically had said, and this is always a thing when you raise money, you always kind of say it may take a little longer to get distributions started. So he said, "Oh yeah, 3 months. We're hoping to start distributions," and it was like 3 months and one day. This guy was a first time investor, spoke and said, "Hey, I don't want to." Got all upset, so they ended up like buying this investor out, which was good because the deals performed phenomenally well. I mean, I think it's been a 75% investor equity increase in 10 months because it's Jacksonville, right? It's been ridiculous. We're about to 1031 it into a larger deal, but it's unfortunate that this guy, the expectation wasn't set correctly, right? That hey, it
Yes.
could be, I'd rather say, hey, it's going to be 6 to 12 months, but it depends on the performance and this and that. Can you talk a little more maybe about any kind of faux pas or things that maybe mistakes you made along the way? Obviously, those processes have changed, but can you share maybe a story from the book or just from your own experience?
I mean, I've had that exact same story happen too, where people have
Mhm.
been like, I mean, they become nervous Nellies, and
Yeah.
they'll call you every other week about like, hey, how's it going? How's it going? Have you done it? I'm like, man, how
Yeah.
quick can I get you your money back? I
Yeah.
mean, seriously, like, can I, like, what, if you can't be patient and understand there's a bunch of different
Wow.
variables that it takes to make these things work, then you might not be cut out to be a passive investor. You might be better off as an active, when you can control and touch the whole thing. And I think that's a lesson, is that some passive investors need to be taught how to be a passive investor. And we send out reports, we send out updates. We'll keep you in the loop when there is a change. We'll tell you. But at the end of the day, I think that like my biggest lesson learned is that you over communicate, because I've had
Mhm.
deals where we weren't sending out enough communications. So now we sent out monthly updates, and quarterly financial statements and those kinds of things. And I think that the biggest lesson is that whatever you do, it has to be repeatable. So we pay our preferred returns on the exact same day of every quarter,
Sure.
So it's like, I think it's
Smart.
22nd of the month, the 22nd of the day after that quarter ended. That's when the pref goes out every time,
Right.
and we used to not operate on a fiscal calendar of December fiscal calendar. Now we do. Everything operates on that. We were operating on a calendar based on when the deal closed. So if the deal closed in July, that was the end of the fiscal year for that deal. Makes sense, because now you've held it for a year, right? And well, it's like a deal cycle calendar versus a fiscal calendar, for like a typical calendar, right? It makes it, if you got one deal, that's very easy. But if you got a bunch of them and every deal's operating on a different calendar, and every deal like, oh no, the preferred return doesn't go out on that deal this month, it only goes out on this one or whatever. The biggest thing that I got for investor relations and investor compensation was systematizing, and
Yeah.
doing things on repeatable time frames.
Yeah.
And once we did that, we were really able to scale, because there's these bottlenecks of confusion that show up if you do things, on small size. They make sense, but the big question to ask is, for every decision you're going to make, well, what would happen if my business got 10 times bigger? you know Not that you have to plan everything that way, but like, if my business got 10 times bigger, would doing it this way still make sense? you know
Yeah.
and if the answer is no, then you either need to examine, like, okay, well, I'll do it this way for now, and at some point I'll have to pivot to a better way to do it. Or maybe I bite the bullet, drink the Kool-Aid, pay a little more money, and do it the right way now, and that just
Yeah.
becomes a habit for my company.
Yeah, totally. No,
And
that's
I've got stories I can tell you on both sides that I've been on both
yeah.
sides of that equation,
Oh
about
yeah.
having to do things too late or done things way early. And it didn't make sense in the beginning. Like, why are we doing it this way? And then you kind of grew into,
Mhm.
like, well, yeah, we've always done it like that. And it makes total sense, you know?
Yeah, that's a really good point. I think too, a lot of people starting out, even for me, starting out, like it was something I didn't really understand that you do need to think about systems and processes and
Mm-hmm.
scale. You can't talk to everybody and be best friends with all your investors. And as much as you'd want to, like, I'm a very relational guy, but I just can't hang out with every single person. So I try to create things like this show or other resources that will help to, I can spend more time with people through that, just as you do, or you write your articles, you do your things through bigger pockets, or write a book. And then also when it comes to your investments and your projects, just having repeatable processes that even if you lose a team member, you've got kind of things in place so that somebody can
Yeah.
step in and help understand how that process works. I think it's great. So Matt, I wanted to ask you, what's next for you? Is anything you can talk about next for you? And you've obviously built quite an impressive, business and things that you're doing with your real estate. But what's next for you in the DeRosa Group?
We're going to do DeRosa Galactic and start building rocket ships. No, I'm
I
kidding.
think I've heard of
Uh,
somebody else doing that. I don't know.
Yeah, man, then my name might be taken, the Galactic thing, right? Huh? Yeah.
Yeah.
No, we're gonna keep doing what we've been doing, meaning like buying mid-sized multifamily apartment buildings. We buy workforce housing, C-class stuff, which is a lot of times older vintages, but that's just how I grew up in real estate. I've always, but I started investing in Philadelphia, Trenton, whatever. I was buying stuff that was built in the 1900s, you know. So
Sure.
buying properties that are built in the 60s and 70s kind of feels like a little bit of an upgrade, right? So I don't mind older vintages, air quote older vintages in multifamily. As some people poo-poo those things, we're fine with that because we know we've seen it all. I've seen, name it, lead-based paint, galvanized pipe, aluminum wiring, Federal Pacific breakers, not afraid of it, know how to get around it. Not that we're cocky about it, but we know those things exist. And you put enough capex budget together, you can modernize an older building. And so we're going to keep doing more of that because that's our niche. And we also want to provide affordable workforce housing to as many people as we can. Um, to go further, Bronson, is like, I'd like for this to be a 2022 thing that happens for us. And we've got a few things on the horizon that could make it come to fruition. But I'd like to get more into green building. I want to do new construction. And I've got two new construction projects that are at some point in the pipeline right now. And I'd like to maybe have a third one. And I'd like to either for those projects or be involved in a third project that is extremely green. So a point where the building is what they call net zero.
Mm,
Like the amount of energy the building consumes for its, energy needs equates to or is exceeded by the amount of energy that the building produces through what name it, geothermal, solar, super tight efficient building envelopes, solar hot water, and any of those initiatives you could do to make it to pretty much not off the grid, but the building's still plugged into the power grid, but the amount of energy that it consumes off the grid is equivalent to the amount of money the building puts back. So
yeah.
I'd like
Is
to be able
that
to get there.
Yeah, no, is the reason for that personally, is that a more of a kind of belief of saving the environment? Is it more of just an efficiency thing? Like what are its kind of the values that
There
hits home for
are,
you?
here's a number. It goes back to transforming lives through real estate, right? When I want to make a difference, I want to make an impact. So, whatever design we come up with, I want to do the Elon Musk thing where we just take it and like, put our secret sauce on a billboard. Here, everybody come get it. Here's how we did it, just like you did with the Tesla. Hey, here's all our engineering. This is what we did, and so that's number one. Number two is, yeah, I do believe that we have a carbon issue, a energy costing issue. We're drinking a lot more energy than we maybe should be, and maybe like lower, more efficient buildings are a possibility there. So for all those reasons, yes, I'd like to do it. And additionally, making it more dollars and cents here, there are people out there, tenants, that agree with everything I just said, that would like to be a part of that too. And I believe that and this is somewhat of an untested theory, aside for in like dense urban areas and like urban core downtowns. There are people, I believe, that would pay premium rents, above premium rents than we've even seen, for being able to live in a 0% a zero energy footprint building.
I'm
you
sure.
know.
I'm sure. Yeah.
Um,
No, you mentioned too the with Tesla and some of the with stuff Elon's doing. I know they took a Tesla and they launched it into outer space. So maybe you
yeah.
could take a small multifamily building and launch it into outer space just for because you can, right?
Why not? Right. You do that and like, well, we get to live
Awesome.
there, I guess. I don't
Yeah,
know,
yeah.
you know.
Hey, one last question for you, and then I want to see how people can connect with you. But what do you
Yes.
think is next for the multifamily market? Obviously, this is a interesting time with lots of money printing and all the stuff that's
It's
going
gonna
on in the
crash.
economy.
No, I'm
Yeah,
kidding.
it's gonna.
Yeah.
Yeah. So what are your so what's next? What's your prediction?
I don't see how multifamily. Here's the one. I'll give you a wild card. Okay.
Yeah.
I don't see how multifamily completely gets cut or has like a major drop in value. I mean, it's going to follow cap. It's going to follow the interest rates. So if interest rates creep up, cap rates are going to follow that, right? And so that means pricing will start getting more and more soft the higher interest rates go. But I don't see anything that's going to drive interest rates to 7 or 8%, right? Um, the wild cards out there are major changes in the job market, but again, I think that's going to affect the top of the market. That's going to affect your A class stuff, versus like a lot of your workforce housing. I was a landlord in 2008 when the market crashed, and I mean, it was tough time to sell. You don't want to be selling around then in 2008, 9, 10, but rents didn't blip in my markets that I was in, and I was investing in all workforce housing markets. They did blip big time in the big markets, in your A class markets, but um, it is just my crystal ball is broken, but my opinion is that I think the market in C class multifamily housing will stay the same if we have a change in the economy. Now, here's my curveball. Here's my I call it the dark horse change. There are folks that have talked about Fannie and Freddie really cranking down on this thing, and because they're a government agency, right? When people buy multifamily, you're going to either buy it on bridge, or you're going to buy it on agency debt, right? Those are the financing options because they're the best in class, the best options we got is multifamily. And right now, it's fairly easy to get agency debt, especially if you've gotten it a few times, right? And the question to ask you, Bronson, is what would happen if Fannie and Freddie decided they were only going to do deals up to 60% loan to value anymore? And what would
Yeah.
happen if Fannie and Freddie decided cash out refinances are only going to be 20%? We're going to drop the amount of cash you can pull out by half, by 50%. We're not going to let you do big pullouts anymore, unless it's a major part of your cost basis or whatever it is. Or we decided that we're going to increase our rates, or we're not going to lend unless you already have a Fannie and Freddie loan. We're not going to lend to you. We don't
Yeah.
lend to anybody new anymore. If they change their terms, I don't think they realize how much that they are really holding the puppet strings, but they are. And so
Yeah.
the big curveball I think that there is if Fannie and Freddie decide that they're gonna whatever it
Change
is,
something.
they're
Yeah,
gonna
and
change
that
something. Do you
and it could
agree?
happen. Yeah, I mean it could happen. I think that would be negative. Of course, interest rates if they rise, that would be negative toward asset values. I also think though too, for the long term, if interest rates go up, generally ownership costs go up because then you're
Mm-hmm.
paying more for things. So and if there's inflation, that generally causes rents to rise over time. So I think it's unlikely we're going to see a big move in rates, kind of like what you're saying. And I think that as inflation is high, I think rents are going to continue to rise. I think it's still going
Yeah.
to be difficult. So I think there's a lot of factors. There's obviously
I think any rate
deflationary
increase would be washed
factors.
out by a cost of living increase.
Yeah,
So rent increase and rate increase would just kind of wash each other out. And I don't think any rate thing is going to drive that. I think NOIs will just go up and property
right.
values will continue to rise. So the one I think that aside from that one game changer curveball there, aside from that, I think that this thing continues to go. Maybe at some point it hits the ceiling because rates can't go down much more unless they do, whatever. But I think that I don't see a crash anytime soon. And if there was, it would be because of what I just said about the rate, about the financing thing. And nobody should be hoping and praying for that because we're all coming to the same well. We're all drinking from the same fountain when it comes to financing, right?
Yeah.
So if they change their game, then it's going to make it hard for anybody to buy in
Well, the
multifamily.
other a couple other factors too. They've printed 40% of all the currency has been created in the last 18 months. So there's just some very inflationary factors there. Regardless, there's a
Sure.
chance we have a crash in different asset classes such as stock market and other things. But yet costs continue to rise, kind of a stagflationary environment. But what I love and what you shared too about doing value add multifamily is you
Yeah.
build in some margin of safety. So even if things go down you still have this, you've added so much value based on the work that you've done. So it gives you additional safety versus buying REITs or Class A type of stuff, which is really pretty amazing. So,
Yeah, I just
well,
held. I mean, during the last crash, Bronson, I just held on to everything, and I turned it okay. I
yeah,
never missed a mortgage payment, knock on wood.
that's great.
Um,
Yeah,
yeah, I mean, I had a bunch of fix and flips going when that happened, and I was like, oh, I guess
yeah,
this is now a rental. I guess we're
yeah,
not
yeah. I guess
selling
we're
this fix
changing
and
it.
flip, and so we're gonna rent out this super bougie house with like lots of really nice appliances and nice countertops and everything like that. That would have been a nice flip. We're just gonna rent it out now for nice
Yeah,
rents,
nice.
So we
Yeah,
got through it, and I think that market cycles change, and the worst that would happen is if you're holding assets that make sense today, and that's the way you get around a market cycle crash. If you're worried about a crash, well, how about your deal just makes sense now?
yeah,
Your deal
exactly,
should cash flow
exactly.
now, should not be in the red now, hoping that it behaves itself in the future. Because
Yeah,
if your deal's making cash flow now, it likely will in the future. So you can just keep cash flowing it
yeah.
until the
It'll
market changes.
be good. Matt, I just wanted to say, really thank you for coming on
Yeah,
today. I
man.
just appreciate you. You add so much value. Your YouTube channel, your bigger pockets, all the things that you're doing. It's very clear that you really care for people,
I
not just
do.
about doing your thing, but you really want to make a difference in people's lives as well as their housing and in the world as well, and the green spaces. So just thank you for all that you bring to the multifamily space. What's a good way for people to get in touch with you?
Super easy, man. DeRosaGroup.com, DEROSA group.com. At that site, they can pick up a copy of my book. They can hear about more passive investment things we offer, hear about education services we offer, all kinds of cool stuff. And they can get to know all of our outlets there at DeRosaGroup.com.
Awesome, man. Well, thanks again for coming on. We'll have to have you on again in the future.
Thanks, Bronson. I enjoyed it.
So Matt Faircloth, you can tell he's polished. He's talked about this for years. He's done it. He's lived the life. And if you're interested in doing your own deal with no money, it's totally possible. The way we do it is with other people's money. So I've personally raised about 20 million for different multifamily deals as well as other types of investments. And it's something that just because you've never done it doesn't mean you can't do it. It just means it's going to take some work, and it really comes through two things. It comes through networking, meeting new people, really getting out there, getting to know people that are doing things that are different that can help you along your path. And the other one is education. There's a lot of great educational events about syndication. If you're interested, you can email me, bronson@bronsonequity.com. I'd be happy to send you some events that are going on that I go to, because I go to a lot of national, local events. And wherever you are in the country or even abroad, there are events that talk about this, which is great. So anyway, I hope you enjoyed this interview. Look forward to seeing you on the next episode of the Mailbox Money Show. You've been listening to the Mailbox Money Podcast. For more free resources, articles, and videos, go to bronsonequity.com. There you can download your copy of the special report, The Single Best Investment Strategy During and After a Pandemic. None of the information shared here is an offer to buy a specific investment, and this is for educational purposes only. Consult your financial, legal, and tax professionals and use your own common sense before making any investment decisions. Thanks for joining us, and be sure to tune in next time for more Mailbox Money.